All right. Today is Thursday, March 9th. This is a recap for the stock market activities today. Now, folks, I got a good one for you tonight. What a day, what a day, what a day it was. Folks, it's getting serious now. The monkey stuff, the funny business, the soft landing crap, this is the end of the bear market, the beginning of a new bull market crap, bullshit, that's over now. We're talking about the systemic risk stage of this economy, meaning the collapse is just beginning, folks. Let's take the events that took place today one at a time. The stock market remains in this coked up mentality where market participants are waiting for any hint of any bad economic news. You know why? Because bad economic news means that the Fed will take it easy with rate hikes, and somehow that's going to save the economy. But have you forgotten that you're celebrating bad economic news indicating a recession is coming, and somehow you think the Fed will save us from that? Because the Fed's hands are tied behind their backs when you have inflation still above 2%. So you're gonna get bitten either by inflation or the recession, one of the other, and actually by both. As inflation morphs into a recession step by step, there is no escape here. But this is what took place. Today we got the news that jobless claims went higher by 21,000 claims. Now, this is bad economic news. Yet the market blasted higher based on this piece of news. Why? Because the market now believes that, we have some bad economic news about jobs. Maybe the Fed will take it easy with rate hikes, and somehow that's good for stocks. Meanwhile, look at what's going on with job openings in construction, for example, collapsing off the face of the earth. You think this is good news for the economy? You think somehow the Fed, by not raising rates by much, will save this economy from the inevitable destination of a massive recession? Of course not. And the problem that we got today is we got some fears of systemic risk. Remember when the experts kept coming on TV, the talking heads, of course, and they kept saying, the Fed can raise rates all they want, the economy is pretty good, jobs are plentiful, the banks are flush with cash, the consumer balance sheets are blah, blah, blah. But now we know that this is all a facade. And behind the facade, all of these banks are now suffering from systemic risk. And today we got a disaster in regional banks. Any of these small banks were down massively, led of course by Silvergate, which lost again more than half of its value in a single session. And of course the disaster from Silicon Valley Bank, which lost over 60% of its value today alone. And after hours, it is down by almost 25%. But you can see all of these regional banks are down big. We'll talk about Silicon Valley Bank in a little bit, but a reminder, if you watched my program about a couple of nights ago, we covered in the options market coverage an unusual set of trades against regional banks. Folks betting against regional banks. We covered the trade against the Bank of Ozark, for example. That trade alone today registered over 500% worth of gains. So the traders knew ahead of time that we have a bomb about to be detonated here in regional banks. And folks, it wasn't just regional banks. It was all over the place. And this is absolutely terrifying. This is the ghosts of 2008. When we have the largest banks in America down significantly, crashing in a single day, it has to send a chill down your spine. We're talking about JP Morgan Chase down almost 5.5% today alone. Bank of America lost over 6% of its value today alone. So did Wells Fargo. And the massacre gets even more severe in regional banks. And even asset management banks. BlackRock was down almost 3.5% today alone. Blackstone lost over 7% of its value today alone. Schwab, I use Schwab, my main broker, lost almost 13% of its value today alone. Something big is happening here, folks. And all in all, this was the worst day for U.S. banks in almost 3 years. And I tweeted today that the crash in financials is giving me Lehman vibes. We now know that we have systemic risk, and this systemic risk could be contagious. We could see bank falling after bank after bank after bank, and then the dominoes, when they start falling, there is no stop here. We saw the same case back in 07, 08, and it's happening again now. And you could say that I am an alarmist, whatever. And this is just about cryptos and about Silicon Valley Bank. But have you forgotten about auto loans, subprime auto loans, with rates surging significantly higher right now? We're not talking about regional banks issuing these subprime auto loans. We're talking about large lenders, such as Ally Financials, such as Capital One. What if these banks collapse too? But we'll take it one step at a time. With this intro out of the way, let's dive right into it. And here it is. In focus tonight. Systemic risk. It is happening right now the same way we saw it back in 2008. And folks, here's the background. We know that something big is happening in Blackstone. Why are we seeing all of these problems happening in the financial system all of a sudden? The answer is we have inflation, and the Federal Reserve, to battle inflation, they're raising rates significantly higher. And the majority of the problem is all of these banks during quantitative easing, they've been buying bonds because bonds values appreciate when yields go down under quantitative easing, when the Fed is endlessly printing money out of thin air. But when the Fed ends quantitative easing and initiates quantitative tightening to combat inflation, what are they doing? They're pushing yields higher, and we have an inverse relationship between bond prices and bond yields. When bond yields move higher in reaction to the Fed raising rates, their prices go down. Now think about it. All of these banks have been accumulating bonds for over a decade under quantitative easing. What do you think is happening to the value of these bonds right now? They're collapsing, and hence the systemic risk. But a step back now. You got a large asset management company, Blackstone, with over $1 trillion in assets under management. Real estate values all over the place. When the Fed raises rates, what happens to the real estate sector? It collapses. What happens if Blackstone collapses and trillions of dollars start to collapse down with it? We already have signs that there is something big is brewing in Blackstone. We got the news this week that Blackstone defaulted on 531 million euros in their Nordic properties. And now Blackstone is blocking investors from withdrawing their cash from their multi-billion dollars REITs month after month now. If everything is going on okay in Blackstone, why do they continue to block withdrawals out of these REIT accounts? Something big is happening here in Blackstone. And of course, last night we got the news that Silvergate Bank, which by the way is just across the street from where I used to work in San Diego. But anyways, we got the news that Silver Bank went kaput. The entire bank collapsed. And the reason is their ties to cryptos and the collapse of FTX with the Sam bankrupt fraud. Now Silvergate is collapsing. So right off the gate in the morning, we know that we have bad things brewing. But of course, the market is going to brush all of this as, okay, this is just cryptos. It is not systemic risk. Other banks are okay. But then we hear the news about Signature Bank, which was down big upon opening in the morning. So we have Silvergate Bank collapsing, and today we got Signature Bank collapsing too, as we see the disaster in the tulip market, aka cryptos, taking place. And in the morning, we talked about Charles Schwab. This was really alarming to me. Why is Schwab down 8, 9, 10%? What's going on here? Well, apparently there was a large block trade selling Schwab about 8.5 million shares right off the gate in the morning. So somebody was dumping an insane amount of Charles Schwab shares. Now try to say Charles Schwab shares 10 times in a row. But anyways, then we got the news about JP Morgan. We've been hearing this news about Jeffrey Epstein and the ties with JP Morgan, and specifically with CEO Jamie Dimon. But of course, it revolves around this man, Jess Staley, who was supposed to succeed Jamie Dimon in JP Morgan, but he decided to go with Barclays. Now, right off the gate in the morning, we heard the news that JP Morgan is suing Jess Staley, shifting the blame. Hey, don't look at us. We don't have any problems, any associations with Jeffrey Epstein. This was his buddy Jess. Look at that guy. We're suing him. We have reputational damage. We have all this talk about JP Morgan with Jeffrey Epstein. This is the guy you should be looking at. But of course, we know that JP Morgan is a criminal organization. It's not a bank. I'm just going to read some headlines for you. And you tell me, is this a bank or is this the mafia? Here's the headline. JP Morgan gold traders found guilty after long spoofing trial. So apparently JP Morgan has been manipulating gold prices for years. Not just gold, but a lot of commodities. To the point where the U.S. government described JP Morgan Commodities trading desk as a crime ring. And it doesn't stop here. The Department of Justice accused JP Morgan with years and years of price manipulation and spoofing. They fined JP Morgan with billions of dollars. And then of course we got the FinCEN revelations a couple of years ago. And we now know that JP Morgan has been washing money for oligarchs, for gangsters, for criminals, for rogue regimes, and hence we call JP Morgan the laundromat. It doesn't stop here. Here's another headline by the U.S. Immigration and Customs Enforcement. JP Morgan Chase bank analyst admits stealing customer info in counterfeit check scheme. Okay? Another one. JP Morgan banker is accused of stealing customers' identities and $1.1 million in cash. Another one. JP Morgan advisor admits stealing $22 million from clients. It doesn't stop here. 2 JP Morgan Chase bankers in Brooklyn indicted for stealing $400,000 from accounts deaths of elderly and deceased clients. The violations of JP Morgan Chase are countless, and since the year 2000, they've been fined over $36 billion for offenses ranging from financial crimes to banking violation to mortgage abuses to money laundering schemes. And of course, JP Morgan says that they're hiring thousands of individuals with criminal backgrounds. You know why? Because we have a labor shortage. So they're recruiting from jails. And JP Morgan says giving people with criminal backgrounds a second chance. No. You need criminals. That's your business model. And of course, we got the bomb today. Here's the headline. JP Morgan Chase was ordered to turn over more records from CEO Jamie Dimon in a lawsuit filed by the U.S. Virgin Islands accusing the bank of facilitating Jeffrey Epstein's sex trafficking. So allegedly, there is a connection between Jeffrey Epstein and Jamie Dimon, and this could be the beginning of the end of Jamie Dimon. And immediately, JPM, the stock was down by over 5% right off the gate. But of course, the bomb, the biggest one that detonated today, came from SVB, which is Silicon Valley Bank. It crashed by over 60%, and it is down yet another 25% or so after hours. So for all intents and purposes, SVB is done. Kaputs. Another bank collapsed within 24 hours. We got two banks now. The CEO, of course, says, everything is fine, stay calm, nothing to see here. Please stop taking your cash out of our bank. What led to the collapse of Silicon Valley Bank? You got all of these startups during the IPO mania in 2020 and 21. They take all of these loans from SVB, pinned against shares that don't really exist because these companies are not public yet, with the promise that they're going to pay all of these loans back when these companies become public in the market. Well, we know right now that this is not an environment for any IPOs. With inflation sky high, with the rates moving higher, nobody wants any of these IPOs, any of these growth companies with no profits at all, the hype, the fraud, the empty promises, no appetite for that at all. And therefore, now SVB realizes that they're not going to get paid back. And investors are now pulling their money away from SVB. Matter of fact, after the bell, we have Peter Thiel, who now says and encouraging investors, take your money out of SVB because the whole enchilada is going down. And folks, it's not just SVB. We talked about how all of these banks been buying stocks that are now down in value, buying bonds that are now down in value. We will look at the unrealized gains and losses in this case on investment securities for banks. We've never seen this number before. This could be the biggest crisis that we've ever seen in financial institutions. But the talking heads, the experts on TV, they've been telling you everything is fine. The banks have plenty of cash. They're hedged against any systemic risk. The consumer balance sheet's pretty good. Really? Well, now you know. Lisa Bloomberg says U.S. bank stocks tumbled by the most in almost 3 years, with the KBW, this is the regional bank index, down by 7% in a single day. She says, is this the dam that has burst with regards to more banks raising capital? ? Is there more to come? ? Think about this. If Silvergate can go down in a single day, along with Silicon Valley Bank, what else? We have a lot of these regional banks and small financial institutions that are not regulated as the big banks. They've been taking a lot of risk in cryptos, in subprime auto loans, in unrealized loans based on promises for companies to go public, loans pinned against stock valuations that now went down big. What do you think will happen, folks? And what really exacerbated the sell-off today is what we talked about in last night's video. We talked about the phenomenon of volume Geddon, which could produce the largest single-day sell-off in stock market history. And I talked about 3 conditions that should take place for this phenomenon to happen. Number 1, an event prompting a massive sell-off. It could be due to a piece of macro data, geopolitical data, doesn't matter. Number 2, 0 date till expiration options, which is an insane phenomenon that we're seeing right now. They pile into the sell-off, exacerbating the volatility and prompting the market maker to dump more shares of the underlying indices. Number 3, if investors panic and they start selling their stocks and rotating to risk-free investments, in this case, bond yields. We talked about how seniors, folks in their 50s, 60s, 70s, with large accounts, 10 million, 20 million, 50 million, why would they take the risk in stocks right now? I think about my clients that I used to manage money for. Right now, they'd be telling me, get us the hell out of the stock market. What is the 1 year paying right now? 5% plus? Please take all of my money, put it in the 1 year, the 2 year. That's good enough for me. 5% risk-free, I'm in. If that happens in a large scale, we will have volume Geddon. Now add to this mixture fears of systemic risk, and we could see the biggest crash of all times, folks. Today, we got fears of systemic risk. That's what's going on with Silicon Valley Bank. What's going on with Silvergate Bank could be contagious. What's going on with the other banks? What kind of risk they've been taking all along that we don't know of, that we're about to know about. But I want to concentrate on number 3 here. Investors panicking and saying, okay, get me the hell out of stocks and rotate my money to risk-free. Today, there was a catalyst for this. And this catalyst was the disastrous budget proposal by President Biden. Of course, on face value, it looks like, oh, Biden is just taxing corporations, investors, and wealthy Americans. All of these greedy people who have been cheating the economy, but no taxes on regular folks. He's of course throwing red meat to his base before 24. That's all what it is. There's no chance in hell of this passing at all. But the risk is here, and investors looking at this will say, okay, get me the hell out of here. This man has lost his mind. If you want to tax unrealized gains on paper, what do you think will happen to all of these banks that are collapsing right now? They barely have any gains left on paper. And you want to tax that too? But of course, in his budget proposal, there's no lack of funding to defense, quote unquote, aka money laundering schemes by the Pentagon, worth about $842 billion. Think about that. Think about what you think about.
Think about what you'd think about.
How many homeless people can we feed? How many homes can we build? How many hospitals? Giving health care, free access to all Americans. We can do all of that with that money. But we're spending it to maintain troops in Korea, in Japan, in Germany, in Philippines, in Kuwait, all over the place. Tell me how having troops in Korea keeps Chicago or Detroit safe. I'll give you $1 million. And of course, there's no lack of funding to Ukraine, $7 billion plus now. But this is the disaster in this proposal. Biden proposes doubling the capital gains tax rate from 20% to 39.6%, almost 40%. Now, mind you, states like California also taxes capital gains by 35%, which means all in all, you'll be paying over 50-60% in taxes if you happen to invest or trade the stock market. This would mark the highest capital gains tax rate since 1978. Corporate taxes will rise from 21% to 28%. But this is the most important part. Meanwhile, corporations just posted their worst quarterly earnings since the pandemic. So a lot of folks today said, to hell with the rich. I support Biden's proposal. It's about time to tax the rich. Be careful, this is a trap. I told you guys before in this program, your taxes will go higher. And you guys said, but Maverick, I make $80,000 a year. He's only going to tax folks who are going to make over $400,000. And I'm telling you right now, on the record, everybody's taxes will go higher. And here's why. What if state revenues go down because of the recession? What if companies start to lose money instead of making it because of stagflation in the economy? This is already happening. What if investors cash out of the stock market because why would I pay 50-60% in taxes? I'm just going to park my money in the risk-free rate, buying bonds, tax-free. Who will fund Biden's budget plan since the government is planning to spend like a drunken sailor? Yep, taxes will go up for all of you. I promise you. Once he gets the second term, all of us will pay more taxes. Promise. It is math, folks. That's all there is. The math doesn't add up. He will need to raise taxes on everybody to fund this insane budget. And I say it's not worth the risk to invest and trade in this stock market anymore. After Biden's proposal to raise taxes to 40%, mind you, this is just the federal. You add state taxes on top of that. He will get a stock market crash of epic proportions before 24. And companies will have to lay off thousands of employees if their equity value drops. Put 2 and 2 together, folks. All of this chaos that we're seeing right now, the Fed raising rates, inflation doesn't want to go down, which means the Fed will have to be more aggressive. We have systemic risk right now in the banking sector. We have an administration that wants to punish investors and traders. You put it all together, it's not worth it anymore. Why would you stay in the stock market anymore? Which means we could be in the verge here of the mother of all crashes. Of course, you add the mechanical elements of zero date till expiration options that could exacerbate volatility. I don't know what to say, folks. I don't know what to say. So let's move on to the stock market coverage, and we begin with the closing of the indices today, and here we go. The Dow Industrial Average down by 543.54 points, or a decline of 1.66%. The Nasdaq leading the pack to the downside by 237.67 points, or a decline of 2.05%. The S&P also down by 73.69 points, or a decline of 1.85%. When we look at the sectors, all in the red. Shame on all of them, no metals at all. And the decliners were led by, obviously, financials, followed by cyclicals, and then materials. We will look at the advanced to decline ratios. The NYSE 9% advancing versus 90% declining. Unbelievable. The Nasdaq 14% advancing versus 84% declining. Now, usually, not always, when we get such suppressed ratios to the downside, we get the opposite reaction in the following day. At least in the futures, we should see a rebound. Well, we all know that we have a major catalyst coming out tomorrow, which is the employment report. And if that comes out hot, specifically wage inflation, we're going to go down again. On to futures, commodities. And the most interesting phenomenon today is equities were down, commodities were down for the most part, but so was the dollar. So were bond yields. So what's happening here? My hunch is today was one of those days of extreme fear and the rush to safety. We're moving from inflation fears to recession fears now, and therefore we have demand for bonds. We saw bond prices moving higher, yields moving down, and we saw the dollar moving down, and the rush to the safety of the Japanese yen, for example. And therefore we can see the contrast between the cyclical oil, energies, all down, be it the WTI, Brent, gasoline, RBOB, heating oil, natural gas, all down big, while the safety in commodities, gold, was higher. Exception, of course, silver, copper, they were down, but gold caught a bit. So reading the tape today tells me that we have a rush to safety here. The safety of gold, the safety of bonds, taking money away from equities and from most commodities. So we see grains commodities down, energy commodities down. Some soft commodities are up today, such as OJ, lumber, and sugar, but for the most part, it was an ugly picture today. And the expectations are this fear continues to take over the sentiment. We will see energy commodities moving down, continuing to go down, along with grains, along with the majority of softs, but we might see gold holding on here. But it's too early to say. We'll talk more about these commodities in the charts analysis. Moving on to the options market, the big casino, what do we see here? The volume all in all, pretty much neutral. We're not seeing huge increases one way or the other, but Tesla remained the hottest table by far, with around 2.6 million contracts traded today. Once again, calls outweighing puts with about 54% as calls. Of course, a lot of them lost money today because Tesla was down almost 5%. Apple at number 2 with around 1 million contracts traded today, and the spread is split 50-50 between puts and calls. Number 3, Nvidia with around 900,000 contracts. And of course, the retail mom and pops, believe it or not, they continue to buy puts here, and their sentiment is right that Nvidia should go down, and maybe it will, but it's going to take time, and it has been frustrating for those who've been buying puts in Nvidia. Today, about 900,000 contracts traded for the name. About 58.5% of those were puts, not calls. On to the unusual activities that took place in the options market today. We begin with the ticker CCJ for Cameco, uranium. Now, in the Biden budget proposal is a lot of spending for nuclear. We're not talking about civilian nuclear. We're talking about the big one. Because now we have to go head and head against Russia and China. They're spending more nukes. We have to spend more. You know where this is heading. But maybe it's going to be good for CCJ. And therefore, somebody bought the 29 calls for the expiration date, April 21st, with expectations that the name will move higher and gain more than 10% by the expiration date. They paid around 60 cents a piece to enter this trade, all in all, spending around $1.7 million. And then we have the trade for the ticker VSCO, Victoria's Secret. It's not the 1990s anymore. Why does this company even exist? But anyways, somebody's buying puts in the name, betting that it will go down, and they bought the 30 puts for the expiration date, April 21st, with expectations that Victoria's Secret will go down and lose more than 8% of its value by then. They paid around $1.20 a piece to enter this trade, all in all, spending around $2.4 million. Then we have the ticker BBY. This is for Best Buy, not Bed Bath & Beyond. That one is triple BY. Anyhow, somebody's buying puts here, betting that the name will go down. Specifically, they bought the 75 puts for the expiration date, April 21st, with expectations the name will go down and lose more than 5% of its value by then. They paid around $2.20 a piece to enter this trade, all in all spending around $2.2 million. Last but not least, what about the ticker triple Qs for the Nasdaq? Somebody's betting on a rebound here coming. They bought the 310 calls for the expiration date, April 28th, with expectations the name will move higher and gain more than 6% by then. They paid around $4 a piece to enter this trade, all in all spending around $4 million. Moving on to the heat map analysis, what do we see here? A bloodbath across the board. We talked about financials, so let's talk about the names that weathered the storm. Most notably, Eli Lilly. Now, Biden is talking about the insulin reduction cost that he gotten his budget proposal. And of course, Eli Lilly reduced prices. You gotta give the president credit for that at least. But the rest of it is absolute lunacy. But now that this bad news is out of the way, we're seeing folks buying Eli Lilly shares. And of course, ironically speaking, in a down day massively, Intel and GE are outperforming out of all names. Now, Intel is down big, so can it get any worse at this point? And GE has been catching a bid year to date. It is ridiculous. I think GE should go down at some point. But for now, there's a lot of short covering. There's a lot of buying. It is cheap, quote unquote. I think it should go down a lot. Now, besides the specific news that we covered for financials, there is no specific piece of news that was the catalyst behind the sell-off today. We know that we have soft data out of China. I've been warning you about the overhyped reopening of the Chinese economy. Today, Alibaba, Pinduoduo, JD, all of the Chinese names are down big. But we also got an American auto manufacturer, GM, also down big because despite the promises by CEO Mary Barra, who said that she's not going to lay off employees, well, in the tsunami of layoffs, it is inevitable. And now, of course, GM is cutting jobs by as much as $1.5 billion. Now, what does that mean? They're offering employees to take cash and leave their jobs. And the reason is Mary Barra is too embarrassed to admit that she was wrong and just say, hey, you know what? I was wrong and I'm going to lay off employees right now. She's too proud, so now she's doing this cute Mickey Mouse game of, oh, we're going to offer employees cash to leave the company. Okay, well, that's not going to be good for the stock. On to the heat map for the ETFs. What do we see here? Bloodbath across the board, even though the dollar was down, bond yields were down, but we do have de-risking. We saw both value and growth down. We saw commodities ETFs such as XLE, XOP for energy, OIH, oil, all down big. Even natural gas, be it UNG or BOIL, all down big. Believe it or not, even gold miners were down. GDX was down slightly today. But of course, we talked about financials. The XLF down big. Look at the KRE, regional banks down over 8% in a single day. What fared a lot better is number one, the defensives. XLU for utilities, XLP for consumer staples, and XLV for healthcare. They were down, but way outperforming financials, technology, oil, cyclicals, which were all down big. And of course, when we talk about small caps versus large caps, they were all down, but small caps underperformed by a lot. And then we got internationals, of course. Chinese stocks are down, the FXI, MCHI, even emerging markets, the EM down big. And my hunch is we're going to see European ETFs also down big tomorrow, be it the VGK, the FEZ, the EWG, because now the fears of this systemic risk will spread across the globe. Now, let's do some charts and then wrap it up, and we begin with the SPY, the S&P 500, 30 minutes chart. What do we see here? We got the ultimate gap and crap, and yesterday I told you that the last hour of the day, the pump that we got that got us above 398 was suspicious, and it was due to zero date till expiration options. Today we got a build up on that. Some excitement in the morning because the dollar was down, bond yields were down based on the slight rise in unemployment claims, but we stopped at 401.2. That was the resistance that was too tough for the SPY, and then came the systemic risk news. We went down to 399.10. That was support number one. Didn't hold for a lot, although after the break, you can see that little tiny candle. We went back in a retest. That didn't work out. Then the chart went down to 398, which is an important number. And the reason is every time we see a crack below 398, we see a pump in the VIX, which is the volatility index, aka the fear index. In English, every time the SPY crosses below 398, we get investors saying, okay, maybe we're going to go back to the lows again. So I have to buy some SPY put options as a hedge, and that pushes the VIX higher. Today we crossed below 398. That did not hold up. And then we got all the way down to the support of 393.58, That didn't hold up either. And the next support we got is 390. We ran out of time, but maybe we're going to go all the way down to 390 by tomorrow. However, keep in mind that the RSI right now is severely oversold, meaning we're due for a bounce. The bounce could come if we have a softer than anticipation jobs/employment report, because that will spark the debate that perhaps the Fed will not be as aggressive as we previously anticipated. Now, I disagree with that narrative. Soft or no soft, the data is clear. Inflation is moving higher again. But in the meantime, we have the conditions. This is really important. We have the technical conditions of a rebound. We just need a spark, and the spark could be a soft employment report. But again, folks, the rips are to be sold until and unless the SPY recaptures 398 as support and the SPX 4000 as support. We'll talk about that in a minute. Here's the daily chart for the continuous contract. What we see here in the SPY, it lost the important support of 3,960. Now forget about the last candle that you see here. I believe that this is an error. Recheck with your own charting program, but the closing was below 3,960 and the volume was way above average. This is a bearish sign, not a bullish one. The RSI is back into negative divergence. The MACD indicator is curling back down, indicating more bearish momentum to come. This is not good, and if this continues, we're going to go down all the way to the support of 3,855. Now the bulls will be alive if they manage to close the week, meaning by tomorrow, above 3,960. Absent of that, down we go to 3,855. And here's the hourly chart for the SPX, the cash index. We have important numbers to talk about here. We talked about these numbers in the morning. Number one, the SPX 4,079.10. Number two, 4,000, which is where the algos are programmed to either buy or sell. Across above, they buy. Crossing below, they sell. And then we have 3,970. This is yet another important support line that I identified a long time ago. And then we have 3,940, which is where the 200 days moving average resides. We got all the way to 4,079.10. That was too tough for the SPX to pass above, and down we went. 4,000 did not hold up, even though it was a battle. It wasn't easy. We went back and forth, back and forth. And today we got a gap above. And I told my viewers, watch 4,000. If we lose the number, the algos will start selling right away. And this is what happened immediately. It wasn't easy. It was a battle, back and forth at 4,000. But ultimately, we lost it. Then we lost 3,970, and after that, the floodgates opened. And even the 200 days moving average did not hold up at 3,940. When we look at the hourly chart, all in all, what do we have here? Isn't this a topping head and shoulder formation that we got today? And when we zoom out to the daily chart for the SPX, this is the most important line that triggered the buying last week, which is the 200 days moving average in yellow. We lost that now. We have a negative divergence on the RSI. We have the MACD indicator, which is a momentum indicator, curling back down, producing more negative/red impressions in the histogram, indicating the negative momentum never really ended and it's about to accelerate. If that is the case, then we go all the way to the weekly chart, and this time around we have the 200 weeks, not days, weeks moving average. Folks, all indicators right now lead that we're going to go down in a retest to the 200 weeks moving average. And if that is the case, we're going to go down by about 5% from this point on. You look at the RSI, it is a negative divergence. We look at the MACD indicator. It's about to cross to negative territory, producing red impressions in the histogram. All roads are saying down we go to the 200 weeks moving average. What about the Qs? 30 minutes chart. What do we see here? A similar phenomenon, gap and crap. We got all the way almost to 300. That didn't hold up. And then we got the important line of 297.76, which is yet another important number. That didn't hold up. We went down to the next support, 294.33, but the selling was extreme in nature that even that number didn't hold up, and we ran out of time before a visit to 290, which is the next support I have. Now, all in all, the chart is extremely oversold from the 30 minutes perspective, which means we're due for a bounce. Can the bounce come right away, or perhaps after another sell-off all the way to 290? It depends on what the jobs employment report will do. But folks, these numbers were extremely important. If I zoom into a 3 minutes chart, look at how 297.76, for example, held up. It was a battle. It held up as support over and over and over and over again. But the sell-off was just too much for it. And the same goes for 294.33. It was a battlefield. But again, the sell-off was just too much. But we'll look at the daily chart for the continuous contract for the Qs. What do we see here? We have a crossing below 12,207. That's gone as support for good now. The volume is way up. That is bearish, not bullish. The momentum indicators, the RSI is a negative divergence. The MACD indicator is curling its way down to produce more negative impressions in the histogram. If that is the case, then down we go all the way to 11,689. If that is the case, guess which names will lead the sell-off in the Nasdaq? The answer is the recent winners, Apple, Meta, Nvidia, and Tesla. But there is hope for the bulls here. If the employment report comes out favorable, they could, keyword could, close the week above 12,207, and that will keep them alive. Absent of that, the bears are now in charge. We will look at the IWM, small caps, 30 minutes chart. This is where the majority of the massacre took place. The support didn't even exist. We got the gap in the morning and the crap right away. 186.30 didn't hold up. But we kept selling all the way to 183. 183 held up for a little bit, but folks, the selling force was just too much, and we got a massive flush down all the way till the end of the day. Now, the obvious is the IWM right now is severely oversold, and therefore I did buy some TNA calls out of the money for tomorrow's expiration, and that is a hedge for my short positions because the TNA is the high-levered bullish index for the IWM, meaning if the IWM goes up by 1%, the TNA appreciates in value by about 3% in that given day. And I'm just using it in case we get a rebound tomorrow. Yet when we look at the hourly chart, where is the next support line? I got it at 180.54, so we could see the sell-off going all the way to this number, and then we get a rebound. But perhaps the most important chart is the Dixie, the dollar index, an hourly chart. Today, the algos, while they were tracking the dollar, the human being initiated a massive sell-off where the correlation between the algos and the dollar didn't matter at all. But it's going to come at play at some point once the human being stops selling. When we look at the hourly chart for the dollar, what do we see here? It is consolidating in a bull flag pattern. Sooner or later, if you look at the hour side, the MACD indicators, we will see a pop higher in the dollar, which will take us above support again. What is support, Maverick? Here it is. The daily chart, 105.63. We got plenty of momentum here. If we get a hot jobs report in the morning tomorrow, we could see the dollar blasting higher. It might go all the way to 107.2. But the risk, of course, is if we get a cooler reading, then the dollar will go down all the way to 104.58, if not below, and you will see the indices moving higher. Right now, the hourly chart of the dollar says higher we go, but it's not set on stone. So we have to look at yet another indicator, in this case, the old man, gold. What does gold say? Gold moved higher today, but it did not close above an important number, which is now resistance, used to be support, at 1842. If gold closed the day at 1842 or above, then I could have said, okay, gold is saying dollar goes down and we get a rebound in equities tomorrow. But for now, we don't have a clear answer. We have a close below 1842. So for now, who has the upper hand, gold or the dollar? The answer is the dollar. And if the dollar has the upper hand, then equities are supposed to go down more. Then what about Brent oil, the daily chart? What's going on here? Barely holding into support, which is the trend line. If that's broken, folks, down we go to 77. And then if 77 is broken, you gotta be bearish energy here. It's not gonna hold. We'll take it one step at a time. Now, what about UNG for natural gas? This is a 2 hours chart. All in all, we have a consolidation range. And last month, we got a massive divergence down. This month, we got a big divergence higher. But we're back within range right now. So all in all, nothing is happening in UNG natural gas. Yet when we look at the weekly chart, we have the possibility of an ABC pattern. We got the A leg, now we have the B leg, the retracement, closing the gap, and then we might get the C leg all the way higher. Because you look at the UNG, it is already severely oversold. You look at the hour side, the MACD, it is just a matter of time before natural gas moves higher. So right now, when we have the risk of a recession, we have the risk of the Fed tightening the monetary policy aggressively, I'd rather be in natural gas versus crude oil, at least for now. When we look at the 10-year yield, what's going on here, we talked about in a day like today, you want to buy bonds, the rush to the ultimate safety, and therefore we see the yield going down. But we also have the phenomenon of the yield curve inversion, where the 2 years moving higher and the 10 is going down. Today was the opposite. The 2-year actually went down more than the 10. So we have a slight steepening in the yield curve. Why is that? The reason is because folks are rushing to the safety of bonds. We're seeing yields moving down. You look at the momentum, the 10-year, specifically the MACD indicator. Now that the bear flag is playing out, now that we have a rejection from 4%, if this negative momentum continues to play out, we'll be down at 3.8% in no time. But bear in mind, when we look at the weekly chart, it looks positive. It looks like we have a bull flag consolidation pattern. We look at the MACD, it looks like the momentum indicator is saying the positive momentum hasn't even started for the 10-year, but it's about to. So we could see the 10-year moving higher again if we get a confirmation that the Fed will indeed raise rates more. What will be the catalyst for the Fed raising rates? How about the jobs report we're about to get in the morning tomorrow? If it comes out hot, along with wages, higher we go, which means down we go in equities. You look at the TLT, bond prices caught a bit today, but again, you look at the hour side, the MACD indicators, they're all firming up, indicating in the short run, we could see the TLT bond prices moving higher, while the 10-year yield moving down. But on the weekly, we have the opposite picture. The 10-year yield will go up, while the TLT will go down. We'll look at the VIX 4 hours chart, we have the ultimate ABC pattern. It got us above the top line of the channel. It got us above 20. We closed at around 22.63. Now it is getting a little bit extreme here, so we might get a pullback in the VIX tomorrow. But all in all, you look at the weekly chart, we've been tracking the MACD, the momentum indicator, and it is showing positive impressions in the histogram. We'll see how it closes by the end of the week, but all indicators right now saying it will be positive, indicating the VIX will move higher in the weeks to come. So 50 Cent was right. On to Apple, the big kahuna, 30 minutes chart. What do we see here? It was positive in the beginning of the day. It caught 153.69 as support. It was consolidating in a bull flag pattern. But folks, the sell-off was just too much. I believe that a lot of investors said, okay, to hell with it. Get me out. Get me out. The Fed is about to raise rates aggressively. Banks are collapsing. Biden lost his mind. Get me the hell out and rotate my Apple money to bonds instead. And if we continue to see this phenomenon, sooner or later, Apple will go down 150 and then 145. But for now, you look at the momentum indicator, the RSI from the 30 minutes perspective, it is severely oversold. So we could see an attempt of a rebound, but that is contingent on a cooler employment report. We look at the weekly chart for Apple. I told you earlier in the week that closing the gap is a slam dunk. And therefore, I did buy the 150 puts, and that paid off handsomely today. But for now, we are in no man's land. We could go to the top range. We could go to the bottom range. We'll look at Tesla, an hourly chart. What do we have here? It held on to 180 over and over and over and over and over again. But folks, the sell-off was just too much. Ultimately, Tesla lost 180, and the next support I got is 172.5. Now, the RSI is really oversold. So we have the conditions for a rebound in Tesla. But again, that is contingent on the employment report. We'll look at the daily chart. With TSLA, what do we see here? The moment we got the momentum indicators switching sides from bullish to bearish, the RSI started moving down into negative divergence. The MACD indicator started showing negative impressions in the histogram, indicating loss of bullish momentum and the start of a new bearish momentum. The name weakened and kept going down. And from a daily chart perspective, the support we got is 164.5. That would be another downside worth about 5% or so. And then what about Bitcoin? Tulips. What do we have here in the daily chart? We talked about the bear flag pattern, which is supposed to take us all the way to 20,593.34. We got there and then some. So now we have a severe sell-off here in Bitcoin, yet the momentum indicators are getting severely oversold, so we could get a rebound, but let's say we go down further before we get that rebound. What is the next support that I got here? It ranges from 18,300 to 18,600. I'm going to go with 18,500. And if we go down there in one shot and the chart becomes severely oversold, then I'm going to say, okay, let's play a rebound here in Bitcoin. You can do that by buying the crypto itself, or you can buy ETFs for Bitcoin. You can buy Coinbase, whatever play you want to play, but we got to get to 18,500 in one shot, producing severe oversold conditions. Last but not least, by popular request, what about Nvidia? We're using a 3 hours chart here. We had a trend line with higher highs, and then the trend line stalled, and we got a double top at around 230. Down we went, and the chart violated the trend line. So the assumption was down we go, and we were supposed to go down. Then came earnings, and the CEO came out and said AI million times. And of course, the retail mom and pops stampeded to buy Nvidia, and they did that via call options. Immediately, we got a pop higher, back above the trend line, but most importantly above 230. And now we have the chart stalling, not going anywhere at all. Why are we seeing this? Because we continue to see huge volumes, at least intraday, in buying call options by the retail mom and pops. Now, a reminder, the market maker, aka the dealer, has been buying a lot of Nvidia shares year to date because a lot of the mom and pops have been stampeding by buying call options year to date. So the market maker is saturated with Nvidia shares. They don't need to buy any more of them. But is the market maker incentivized to sell right now? The answer is not quite, because it continues to see more buying of call options. And we're not seeing significant buying of put options saying that Nvidia will go down. We're not seeing huge volumes. We're not seeing buying of put options closer to the money for the market maker to say, okay, I have a risk here of maybe these put options expiring in the money, and I got to dump some shares here as a hedge. We're not there yet. So the market maker is saying, okay, call options holders, buyers, let's see what you got. But if time passes and no more buyers show up, we don't see a huge volume in buying call options, then I don't need to hold on to these shares anymore, and the market maker will start to dump. And the line in the sand here is 230. If we have a closing below 230 from a daily perspective, then down we go big time in NVIDIA. And the support I got is 207.65. Moving on to the conclusion of this video, what do we have in the economic calendar tomorrow? Of course, the most important event is the employment report by the Bureau of Labor Kitchen Statistics. Let's see what they cook here. But the most important piece of this report is average hourly wages. If they go higher significantly, boy, we're going to go down big in equities. But if it is a tame rating or hourly earnings are not high by a lot or maybe went down by a little bit, then you're going to see equities staging a rebound. With that, folks, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again over the weekend. Take care.
Sell it all today.